Throughout the last 15 years of being in the finance industry, I've dealt with thousands of different credit profiles. Through working through so many different clients, I've found certain algorithms, certain solutions to be able to help them increase their credit score. And some people, they had, no money to be able to, work towards. And some of our clients had, millions of dollars that, didn't even need to use credit, but they couldn't qualify because they weren't using it properly. So through credit education and coaching and different tools and resources, I've come up with a few different strategies on how to help somebody increase their credit score without spending money. And that's a topic that I want to talk about today. And before I go forward, I want to build some of the foundation so that we can start to grow, and so you understand of what needs to happen moving forward. So let me go into what I developed, something called the perfect credit formula, how to get to an 800 FICO score. There's 4 different types of accounts, what we call them trade lines. You have a mortgage loan, auto loan, installment loan, credit card, revolving accounts. The age of these accounts makes a big difference. The longer establishment, the higher the score goes up. So you have somebody who is, 18 years old, just starting out. It's going to be harder for them to qualify and build their credit versus somebody who's been, around for, who's 50 years old and has been having credit for the last 30, 40 years. So it's an important aspect, because why does age matter? It allows the lender to look at your history, your borrowing history, and make a determination if they're going to qualify you. Next biggest thing that I always come across is credit utilization. So let's just say you have a credit card with a $10,000 limit and a $3,000 balance. At that point, you're using 30% of your utilization. Once you go above 30%, it starts to affect your scores negatively. I'm going to go into different strategies later on how to be able to diminish that without spending money, but it's one of the major factors that we come across on a daily basis. Next is your payment history. So no lates, collections, public records, bankruptcies, etc. This stays on for 7 to 10 years. Now, what I want you guys to do is put everything on Autopay. So if you go on vacation for a month, forget to make a payment, you don't miss any type of late payments on your credit profiles. That 7 to 10 years is going to really hurt you dramatically, from that. So be system dependent, not human dependent. Next thing is your credit inquiries. The rule of thumb is no more than 6 per 6 months. In some instances, I've seen somebody with a 750 FICO get denied for a loan just because they have too many excessive inquiries. One of the biggest things that I come across all the time is car dealerships, right? Because why does somebody have like 30 inquiries on their credit report when you go to a car dealership? Because all the dealership cares about is selling you that car. They don't really care about you ruining your credit. So this is something that's very huge that can diminish your score and get you denied for a loan moving forward. We're into this category. Now, what is an authorized user? So if I have a credit card for $10,000 and you don't have any credit history, so what happens is that that account is going to get mirrored onto your credit profile. So it actually works both ways for improving your credit score. This is why I say very important, perfect credit formula. If you add yourself to somebody's account and they're maxed out, now, and because it's being mirrored, that's going to actually affect your score and decrease your credit score by adding that. Now, make sure that their payment history, their payment utilization is below 30%, there's no derogatories. So that is one of the main things I look for from that. Now, every account is going to be able to increase your credit score by 5 to 20 points. So if you add yourself to 1, 2, 5, 6 accounts, that could potentially increase your score 100 points. Great tool. Now, let's just say that you're qualifying for, a mortgage loan, and the difference between you having a 680 FICO versus a 740, you're saving yourself like a 0.5% in interest. Well, over 30 years, that's thousands and thousands of dollars that you're going to be saving just because you have that influx of a credit score during the time of qualification. Now, the other thing that it can do is offset your credit utilization. Now, if you have a your total of accounts with a total percentage of like 85% usage, and if you add yourself to a few different cards, that total credit utilization is going to be diminished and your score will increase. However, banks aren't really stupid, right? They look at the individual accounts and also the total. So don't think by adding a whole bunch of credit cards that that's going to get you qualified for the loan that you're trying to apply for, right? So, but it will help with offsetting the total. It's definitely great for perception moving forward. So, but if you don't have access to any friends and family or somebody that can add yourself, there's a lot of different people on the internet, or we have access to like 1,200 of them that we use for our clients. So it's very, very important, to be able to offset all different elements, but also increase your scores. Great, great tool of increasing your score. Now, one of the other things I wanted to talk about, and it's a common issue that I come across, is definitely in the credit utilization space category, is the shift to debt. There's a lot of things you can do by shifting the debt from either the revolving account to installment, and how that can dramatically increase your scores. So, installments have a different classification when it comes down to your scoring systems. So if you have a revolving account and you switch it to an installment, the fluctuation will differ, because an installment is a fixed payment for a particular term. Revolving is, I can go to Las Vegas tomorrow and spend a $10,000, max out my credit cards for $10,000, put everything on red, if I'm playing roulette, and then hopefully I win, hopefully I don't, but it's a big gamble. And let's just say I lose, max out credit card, your score will actually decrease dramatically. I've actually seen somebody's score drop 100 points just because they have maxed out credit cards. It's amazing how it reflects. So the whole concept here is that if you are going to apply for an installment, you have to make sure that your score is high enough, before you apply. It's one of the number one things that I teach when I coach my clients. So if you do have some capital, or you want to pay down your revolving accounts, let that score jump up, and then qualify, and then do the shift, it's much more your better interest. There are accounts or lenders that will accept less than perfect credit for this equation to help solve it, right? So stepping stone theory is what I like to call it. Now, the other aspect here, of course, to shift the debt, but if you even add some authorized users, increase your credit score, try to pay down your utilization, increase the credit score, then go and apply. Now, the next element here, which is what I call the balance transfer strategy, is that, let's just say that you have 5 credit cards and they're at $10,000 limit each. Now, one of the credit cards, you're maxed out. The second card, you're at 50% utilization, $5,000. Next one is $2,000 in utilization. The other 2 are paid off. They're free and clear. Now, what I can do here is shift the debt and doing a balance transfer, and to even out everything between all 5 accounts. So you're going from 100%, 50%, 20%, 0, 0, shift the debt to 34%, which is 3,400 all across the board. Your score will increase dramatically and it gets you into compliance. The banks look for something close to that, solves the problem, then go and install and apply for that installment or anything that you're trying to qualify for. Okay, so it's, rule of thumb is always best to apply when scores are at the highest and the debt is at the lowest. Okay, that's general rule of thumb from that. Now, the next topic I want to talk about is the bridge loans. Okay, there's a few different categories from here, but the bridge lending is something that's very powerful if it's utilized correctly. Now, if you do have the luxury of borrowing from friends or family, temporarily, let's just say that you call your mom or your dad and, hey, mom, you borrow, $10,000, pay down my credit card, score shoots up, you qualify for the installment, or if it's a business loan, for an example, take that money of that qualification and then pay them off, after the fact. So it's very, very evident if you could borrow from a third party versus trying to qualify, because you don't want to have brand new accounts pop up, because your score will decrease for new accounts. Typically takes about 1 or 2 months for that score to increase. But it all depends, of course, what your outcome, what you're trying to accomplish with your credit moving forward. The next thing is we've utilized is called credit partners. So let's just say very commonly used in the business funding world. That think of a company is a vehicle, and all you're doing here is you're switching out the driver. So if you have a CFO or chief financial officer, or somebody who has great credit, or at least the right qualifying factors for for the new loan, that you can switch them out, get qualified for the new loan, and once you have that amount of the new qualification for that loan, then you pay them off, or you make an arrangement. The world goes, the theory goes from there for how you make that make that contract with them. But if they can qualify for a loan, it's a very powerful tool. You don't have to obtain from new new installment debts to offset the utilization. At the same point, if you want to utilize the credit partner, have them qualify for the loans, take that loan, pay off your debt, and then qualify for that, or to do new venture and to generate that revenue and pay them off that way. There's a lot of different ways you can play with that. Private lenders. So there's a lot of private lenders that a few that we know, for example, that you can have them qualify for. Have you qualify with them, it doesn't show up on your personal credit. There's no new accounts that will be showing up, but it can reduce the utilization, helps you qualify, and then you pay it back through the arrangement that you have there. Another thing I also wanted to mention is that business credit doesn't show up on your personal credit. So business loans, if you qualify for something from the business, like a line of credit or a credit card, and you take your personal credit utilization at being about 30%, shift it to the business. It stays under the EIN. Get your score showed up, then you go in and you qualify for the new loan, and then you can offset it or repay it. A lot of different ways of solving that. So it's very, very powerful if you can open up the channels through business and shift the debt from back and forth. Now, one of the last things I want to talk about is get into the habit, right? Ask for those increases as you move forward. What I like to teach is something called, the best medicine is preventative medicine. So get in the habit of calling your credit cards companies and asking for an increase, but only do it if you do a soft inquiry. Do not do a hard inquiry, because you don't want to violate the rule of inquiries, right? No more than 6 per 6 months. So call up Discover. I think Discover has a rule of every 30 to 90 days you can ask for an increase. American Express or Chase, I think, is every 6 months. So everybody's a little bit different. You want to check with them, but try to limit the number of inquiries if you want to increase that. Get in the habit, right? Be proactive, right? Time is definitely a main factor for increasing your credit. So if Discover gives you an increase every 3 months, great. You go from 1,000 to 3, 3 to 5, 10 to 20, 20, 30, 50, and so on. So it doesn't happen all the time, right? Usually that age factor makes a huge difference. And always try to have low utilization before you apply. All right, so this is a very big, there's a lot of information to intake, but I wanted to break it down in different segments, because if you master this and you have the right education to maintain these different moving parts, it's a very, very powerful tool, right? Always want to make sure to keep your personal credit as clean as possible, as high, scores will let you save thousands of dollars when you go and apply for whatever you're trying to apply for. All right, thank you.